We are in week 7, everyone. We're so close. 2 weeks, 3 chapters, 2 sets of homework, and a final to go. You are almost there. This week we're going to talk about chapters 12 and 16. Chapter 12, cash flow estimates. This is, again, closely related to how things work in business. Um, Again, we have the example that you can follow along with. We have a proposed project, equipment cost, 280,000, 100% bonus depreciation. So after tax, it's 210,000. Change in net operating working capital. Inventories are going to go up by 25,000. Accounts payable will rise by 5,000. An effect on operations. New sales of 100,000 units a year at $2 a unit, and the variable costs are 60% of sales. This is pretty common when you're looking at projects in the real world. Proposed project, economic life is 4 years. Equipment eligible for 100% bonus depreciation for taxes. We're interested in cash flow, so our focus on tax depreciation. Equipment will be fully depreciated at time of purpose for tax purposes. The salvage value is 25%, and the tax rate is 25% with our weighted average cost of capital at 10%. Whew, that's a lot of stuff. Now we get into determining the project value. We're going to estimate the relevant cash flows. How much money are we going to get in annual operating cash flows? Identify the changes in net operating working capital, NOWC. Calculate terminal cash flows after tax salvage and recovery of net operating working capital. So first we find the net operating working capital. Inventories are going up 25,000, funded in part by AP going up 5,000. So that's 20,000. Our initial outlay is $210,000 after taxes because we can depreciate the full 280 in the first year, which lowers our tax bill by 70. It makes the equipment layout cheaper. So we have our free cash flows in the first year of negative 230. And then we go through and we figure out, remember, operating costs. We were going to sell 100 of them at $2 each. Operating cost is 60%. Earning before income taxes is 80, tax at 25. So our earning before income minus taxes is 60. Depreciation is fully done in the first year, so we're good. 60 a year. Terminal cash flows, this just means at the end of it when we sell it, salvage value is 25. We have our tax because we took the tax all at the beginning. So we have 1875, our net operating working capital of 20, our terminal cash flow is 3875. So our free cash flows is a 9875 in thousands. So this is a profitable idea. How is net operating working capital recovered? Recovered at the end of the project's life. There's no tax impact. Is there always a tax on salvage value? Depends on if the salvage value is greater than the book value, then you are. If the salvage value equals the book value, there's none. If the salvage value is less than the book value, there may be a tax credit. Should financing effects be included in cash flows? Nope. Dividends and interest expense should not be included in the analysis. Financing effects have already been taken into account by discounting cash flows at the weighted average cost of capital of 10%. So we bake that into our equations, into how we're looking at this. And if we did, it would be double counting it. Should a $50,000 improvement cost from the previous year be included? No, it's a sunk cost. We talked about that last week. Sunk costs don't go into it. If the facility could be leased out for 25,000 per year, should this affect the analysis? Yeah, we want to know if we're losing money by doing something else. We want to compare apples to apples. We could make money doing this, and we can make money doing that. Which one is the best choice? So that way we don't choose the wrong one. Here it's 18,750, and if you do the whole cash flows over the life of the 4 years, you're going to find it's less than the 98. If the new product line decreases the sales of the firm's other lines, would this affect the analysis? Yeah. Yeah, because we're making less money. It's not a good evaluation then. You need to make sure that we're taking that into account. When are we going to get paid back? What's the net present value? What's the IRR? What's the MIR? Net present value is negative 13. The IRR is 7.5. The MER is 8.4. And the payback is 3.5 years. If this were a replacement rather than new, would this affect the analysis? Yeah. Yeah, the old equipment would be sold and new equipment purchased. The incremental cash flows would be the changes from the old to the new situation. So instead of going from 0 to 100, what is it, 50 to 100, 100 to 100? The relevant depreciation expense would be the change with the new equipment. If the old machine was sold, the firm would not receive the salvage value at the end of the machine's life. What types of project risk are there? Standalone, corporate risk, market risk. Standalone, the project's total risk if it was operated independently, usually measured by standard deviation. It ignores the firm's diversification among projects and investors' diversification among firms. I can tell you standalone risk is usually the one that we looked at most of the time. We did not look at corporate risk so much. We talked about it. Corporate risk is the project's risk with considering the firm's other projects, diversification within the firm. Corporate risk is a function of the project's net present value and standard deviation and its correlation with the returns on other firm projects. So is this going to add to the portfolio, detract from the portfolio? Is it going to be helpful? What is market risk? The project's risk to a well-diversified investor. Theoretically, is measured by the project's beta, and it considers both corporate and stockholder diversification. Are you doing a good job as a firm making sure that you're working against the market risk to keep your firm going? What type of risk is most relevant? Market risk is the most relevant risk for capital projects because management's primary goal is shareholder wealth maximization. We want to make sure that we're minimizing the market risk so that we can make money. Corporate risk affects creditors, customers, suppliers, employees. It shouldn't be ignored. But like I said, standalone risk is usually the easiest to measure and it's the easiest to wrap your hands around. It's not theoretically correct, but it does not necessarily lead to poor decisions. If you look at the new widget maker and it shows that it's going to make money over the long run, it's okay if you don't look at all the other things, especially if you're just in the widget making business. If you're in the car wash business and you have a new car wash, is that car wash going to make more money as long as it's not taking away from another business? You wouldn't build two car washes right next to each other in the same city. You would have them different parts of town. Are the three types of risk generally highly correlated? Yeah. Since most projects the firm undertakes are its core business, standalone risk is likely to be highly correlated with its corporate risk. In addition, corporate risk is likely to be highly correlated with its market risk. If you make a good decision for your business and you're a small business, it's probably going to equate to your business making more money. You want to make sure you're looking at the cost of capital, the weighted average cost of capital, and make sure that whatever you spend your money on is costs less than what you could find other places. What is sensitivity analysis? Sensitivity analysis measures the effect of changes in a variable on the project's net present value. To perform a sensitivity analysis, all variables are fixed at their expected values except for the variable in question, which is allowed to fluctuate. Resulting changes in net present value are noted. What are the advantages and disadvantages of sensitivity analysis? It lets you know because the market might be good, the market might be bad, it just depends on the advantages, or it just depends on what's going to happen in the businesses. You want to look at and see what might happen depending on what happens in the market. That's some of the advantages. Disadvantages does not reflect the effects of diversification, does not incorporate any information about the possible magnitude of the forecast errors. If you're too rosy or you're too into the world, yeah, that stuff's going to happen. If expected inflation equals 5% is net present value biased, the discount rate already reflects the market's inflation expectation. That's the weighted average cost of capital. Remember, when we figure those numbers out, we have our market risk and we have our inflation baked in to the 7.5%. But if inflation goes up, it can change the cash flow forecast. Hopefully, if you're doing a good job as a business, you pass on those cash flow changes onto the customer. And you can see here, we're actually making more money because we're passing on those inflationary things to the customer in the revenues. Yeah, our operating costs go up, but we've passed it on to the consumer as well. So we should be okay. And here we can see our net present value is 10.4, IRR is 11.9, MER is 11.2, payback is 3.3 years. So with inflation in there, the rising rates, we actually, the project looks better. So here's a scenario analysis where worst, base, best, all of our unit cells, and then we go through, if the worst happens, we're going to lose money. Normal, 10.4, best, 63.9. So we never plan for the worst, but you want to make sure you're prepared for it. Is this project likely to be correlated with the firm's business? How would it contribute to the firm's overall value? We would expect a positive correlation with the firm's aggregate cash flows. As long as the correlation is not perfectly positive, we would expect it to contribute to lowering of the firm's overall risk. So as long as it's not exactly the same as the other stuff you're doing, you should be okay. But are you going to do something that's closely correlated to your business? Probably. If you have the car wash business and you put one at one corner, you put one a few miles away so that way you get other people that live in that neighborhood, and hopefully that car wash in that other neighborhood does just as well, if not a little bit better than the current one you have. If this project has a high correlation with the economy, how would corporate and market risk be affected? The project's corporate risk would not be directly affected. However, when combined with the project's high standalone risk, correlation with the economy would suggest the market risk is high. Yeah, so if you have a business and in good times people spend a lot of money and then bad times happen and people cut you out of their budgets, yeah, that's not good. It's going to be risky. What subjective risk factors should be considered before a decision is made? Numerical analysis sometimes fails to capture all sources of risk for a project. If the project has the potential for a lawsuit, it may be more risky than previously thought. If assets can be redeployed or sold easily, the project may be less risky than otherwise thought. Other subjective factors. Are there enough people in the area to hire to build a new widget factory? Can the town support a second car wash on the other side of town? Um, just things like that. You got to look at your business and what you do. And just because the numbers say that it might be profitable, you have to look around also and ensure that it makes sense for your community and for your business. All right. That's chapter 12. We move on to chapter 16 next. We only have two left after this. You guys are humming along. Keep it going.